You finally did it. You paid off your loan. Maybe it was your car loan, your student loan, or a personal loan you've been struggling with for years. You made every payment on time, stayed disciplined, sacrificed things you wanted, and reached that moment where you could finally say, I'm debt-free. But then something unbelievable happens. You open your banking app or check your credit monitoring service, and suddenly your credit score has dropped. Not by a few points. Sometimes by 20, 30, even 50 points. And now you're sitting there confused, frustrated, maybe even angry, wondering, how is this possible? I did the responsible thing. If this has happened to you, you are definitely not alone. Millions of people experience this exact same situation every year, and most of them panic because nobody ever explains how the credit system really works. We're taught that paying off debt is always good. But what most people don't realize is that credit scores don't think like humans. They think like algorithms. And sometimes, those algorithms react in ways that make absolutely no sense at first. In today's video, I'm going to break down exactly why your credit score can actually drop after paying off a loan, what's happening behind the scenes inside the credit scoring system, whether this drop is temporary or permanent, and most importantly, what you should do next to recover your score quickly. Because once you understand how credit scoring really works, you stop panicking and start using the system to your advantage. The truth is your credit score is based on several different factors working together at the same time. It's not just about whether you pay your debt off or not. Credit bureaus and scoring models look at things like your payment history, the types of accounts you have, how long your accounts have been open, how much credit you're using, and even how active your accounts are. So when you pay off a loan, you're not simply removing debt, you're also changing the structure of your entire credit profile. That's why someone can become financially healthier while their score temporarily drops. Sounds crazy, right? But by the end of this video, it's all going to make sense. I'll explain why closing a loan can hurt your credit mix, how your account age affects your score, why active accounts matter more than most people realize, and why different apps can show completely different score changes. I'll also show you the smartest strategies people with excellent credit use to bounce back fast and keep their scores climbing long term. So before you panic over a sudden drop in your score, stay with me through this video. Because understanding this one topic could save you from making major financial mistakes in the future. Before you can understand why your credit score dropped after paying off a loan, you first need to understand how credit scores actually work. Most people think credit scores are simple. They believe if you pay your bills and eliminate debt, your score should automatically go up. But credit scoring systems are much more complicated than that. Your score is calculated using several different factors that work together at the same time. The biggest factor is payment history, which makes up about 35% of your score. This shows whether you pay your bills on time consistently. Then comes credit utilization, which measures how much of your available credit you are using. After that, the system looks at the length of your credit history, your mix of credit accounts, and any recent applications for new credit. Here's the important part most people miss. Paying off a loan changes multiple parts of this formula instantly. You may remove debt, which is good, but you could also reduce your credit mix, close an active account, or change the average age of your accounts. That's why your score can sometimes drop even when you made a smart financial decision. Credit scores reward long-term account management, not just becoming debt-free overnight. One of the biggest reasons your credit score may drop after paying off a loan is because of something called credit mix. Credit mix refers to the different types of credit accounts you have on your report. Credit bureaus like to see that you can successfully manage different forms of debt. This can include credit cards, auto loans, mortgages, student loans, and personal loans. If you only have one installment loan and you pay it off completely, that account may close and disappear from active reporting. Suddenly, your credit profile becomes less diverse. For example, imagine someone who has 2 credit cards and 1 car loan. The car loan shows lenders that the person can handle installment debt responsibly over time. But once that loan is paid off and closed, the profile now only shows revolving credit accounts. Even though the person became financially stronger, the scoring system may temporarily view the profile as less balanced. That can lead to a short-term drop in points. This is one of the most frustrating parts of the credit system because it feels backwards. You would think eliminating debt would always help immediately. But the algorithm is designed to reward experience managing multiple account types over long periods of time. Another hidden reason your score can fall after paying off a loan is because of your average account age. Credit scoring models love stability and history. The longer you've had accounts open and active, the more trustworthy you appear to lenders. Older accounts show that you have experience managing credit responsibly over time. When a loan closes, especially an older loan, it can affect the average age of your credit accounts. For example, imagine your oldest loan has been open for 7 years. Once it's closed, newer accounts on your profile may start carrying more weight in the scoring formula. That can reduce the average age of your active accounts and cause your score to drop temporarily. This is why people with long credit histories often have stronger scores than younger borrowers. Time matters a lot in the credit world. It's also important to understand that different scoring models treat closed accounts differently. Some continue counting closed accounts for years, while others slowly reduce their impact over time. So, if your score suddenly drops after paying off an older account, it doesn't mean you did something wrong. It simply means the scoring model is adjusting to changes in your credit history structure, and sometimes those adjustments can temporarily lower your score before it stabilizes again. One thing many people don't realize is that active accounts help your credit score every single month. Every time a lender reports an on-time payment to the credit bureaus, it adds another positive mark to your credit history. This ongoing activity tells the scoring system that you are still actively managing debt responsibly. But when you pay off a loan completely, that account usually closes. Once it closes, it stops sending monthly positive updates to the credit bureaus. In a way, you lose one of the accounts that was helping build your score consistently. Think of it like removing a strong player from a sports team. Even though that player left on good terms, the team still loses part of its strength. The same thing can happen with your credit profile. If the loan you paid off was one of your strongest active accounts, your score may react negatively for a while. This is especially common for people who don't have many accounts open to begin with. Someone with only one credit card and one loan may notice a much bigger score drop than someone with 10 active accounts. The good news is that the positive payment history from that closed loan usually stays on your report for years, which still helps your long-term credit profile significantly. Credit utilization is another major factor that can indirectly affect your score after paying off a loan. Credit utilization refers to how much of your available credit you are using, especially on credit cards. Experts usually recommend keeping utilization below 30% and ideally below 10% for the best scores. Now, you might wonder, what does a paid-off loan have to do with credit card utilization? The answer is behavioral. Many people feel financially relieved after paying off a loan, so they start spending more on credit cards. Maybe they take a vacation, buy new electronics, or simply rely more heavily on cards because they no longer have loan payments. If those card balances rise, utilization increases quickly, and that can hurt your score. Another issue is that some people close credit cards around the same time they pay off loans. Closing cards reduces your total available credit, which can make your utilization percentage jump even if your spending stays the same. For example, using $1,000 on a card with a $10,000 limit looks much better than using $1,000 on a card with a $3,000 limit. This is why maintaining low balances and keeping older accounts open is so important for long-term credit health and score stability. Timing also plays a huge role in why your credit score changes after paying off a loan. Many people expect their score to update instantly and reward them immediately, but that's not how the system works. Lenders report information to the credit bureaus on different schedules. Some report once a month, others report at different times, and updates can take weeks to fully appear across all three major credit bureaus. So when you pay off a loan, there may be a temporary adjustment period where your credit profile looks different before the scoring system fully settles. During that time, your score may fluctuate up and down unexpectedly. Some people see a drop for only a few weeks, while others may notice changes lasting 2 or 3 months. This is completely normal. The biggest mistake people make during this period is panicking and applying for new credit immediately to try fixing the problem. Opening new accounts too quickly can actually make things worse by adding hard inquiries and lowering the average age of accounts even more. The smartest approach is usually patience and consistency. Continue paying all bills on time, keep credit card balances low, and allow the system time to adjust naturally. In many cases, scores recover gradually without needing drastic action at all. Another reason people become confused after paying off a loan is because not all credit scores are the same. You might check one app and see your score dropped 40 points, while another app shows almost no change at all. That happens because different companies use different scoring models. The two biggest systems are FICO and Vantage Score, and they calculate risk differently. On top of that, lenders often use specialized versions depending on the type of loan you're applying for. Mortgage lenders may look at one version, while auto lenders use another. This means the score you see on a free banking app may not be the exact score a lender sees when reviewing your application. Some models are more sensitive to account closures, while others place greater importance on utilization or payment history. That's why two people with nearly identical financial situations can still have different scores across different platforms. Understanding this helps remove a lot of unnecessary panic. A temporary drop in one score does not automatically mean your financial future is ruined. What matters most is the overall health of your credit profile over time. Strong habits like paying on time, keeping balances low, and maintaining older accounts matter far more than short-term fluctuations on a single credit monitoring app. So now the big question becomes, how do you recover your score after it drops from paying off a loan? The good news is that in most cases, the solution is simple. First, continue making every payment on time because payment history remains the most powerful factor in your credit score. Second, keep your credit card balances low and avoid maxing out cards. High utilization can damage your score much faster than most people realize. Third, avoid closing old credit cards unless absolutely necessary. Older accounts help strengthen your credit history and increase available credit. Fourth, don't rush to apply for multiple new loans or cards, trying to fix the drop immediately. Too many applications can create more damage through hard inquiries and shorter account age averages. Instead, focus on consistency. Monitor your credit reports regularly for errors and make sure all information is accurate. If you're rebuilding credit, secured credit cards or small installment loans can also help over time. Most importantly, remember that strong credit is built slowly. There are no magic tricks or overnight fixes. The people with excellent credit scores usually succeed because they stay patient, manage debt responsibly, and allow time to work in their favor. Consistency always beats shortcuts when it comes to building lasting financial health. So, at the end of the day, if your credit score dropped after paying off a loan, don't panic and don't think you failed financially. In reality, becoming debt-free is still one of the smartest financial moves you can make. The problem is that credit scores don't measure your happiness, your financial freedom, or the stress you've removed from your life. They simply measure risk through algorithms and data patterns, and sometimes those algorithms react in strange ways that don't reflect your true financial progress. What matters most is understanding how the system works so you can make smarter decisions moving forward instead of reacting emotionally to every small score change. Remember, a temporary drop does not define your financial future. Most score decreases after paying off a loan are short-term and recover with time, consistency, and responsible credit habits. Keep paying your bills on time, keep your balances low, protect your oldest accounts, and stay patient. Strong credit is not built in weeks, it's built over years of discipline and smart financial behavior. And honestly, being debt-free with a slightly lower score is often far better than drowning in debt with a higher one. Financial freedom should always be the real goal, not just chasing a number on a screen. If this video helped you understand why your score dropped after paying off a loan, make sure to hit the like button, subscribe to the channel, and turn on notifications because we're breaking down the financial system in simple language that actually makes sense. Also, I want to hear from you. Has your credit score ever dropped unexpectedly after doing something financially responsible? Share your experience in the comments below because your story might help someone else who's confused and stressed right now. Thanks for watching. Stay smart with your money, and I'll see you in the next video.